What's happening, my money savvy trailblazers? Welcome back to another episode of the Do.Different.Better show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connect Up Institute, and managing director of the Integrated Capital Fund. Today, we're diving into a topic that affects every single dollar you earn, save, or invest: tax policies and how they shape your financial future. Now, let me hit you with a fun fact. Did you know that the U.S. tax code is over 70,000 pages long and changes every single year? Yes, you heard that right, 70,000 pages. Staying on top of the tax laws isn't just for accountants. It's really essential for anyone serious about building wealth. Whether you're an everyday investor, an entrepreneur, or just someone trying to hold on to more of your hard-earned cash, understanding the tax policies and how they affect you is a game changer. Today's episode is all about breaking down the proposed tax changes that could impact your wealth building goals. We'll cover everything from capital gains taxes and to small business deductions and how to make informed decisions in an ever-evolving tax landscape, particularly under a new elected administration. Okay, so let's dive into the thick of the matter. What's changing and why should you care? With every new elected administration, there will surely be some new and modified tax codes that could impact your wallet today and for the future. The government is always looking for ways to tweak the tax laws to fund different programs and address deficits or incentivize certain behaviors. Here are some key areas that we're going to be keeping an eye on. The first one is capital gains taxes. If you're an investor, this is huge. Capital gains taxes are what you pay on the profit from selling an investment like a stock or a piece of real estate. Proposed changes might increase the tax rate for high income earners. And when I say high income, I'm usually talking about people making over $300,000. For example, someone earning over $1 million annually could see their capital gains tax rate jump from 20% to over 39%. Now, this hasn't happened yet. There's talks happening. There are bills that are in Congress, but we won't know. But it's definitely something. If you know that you're a high income earner, that's something you're going to want to pay attention to. So why does this matter? Imagine you've been holding on to a stock for years, or maybe you inherited a stock and you decide to sell after it's doubled or tripled in value. Under higher capital gains rates, a significant chunk of that profit could go to Uncle Sam instead of into your retirement or your next big investment that you've been planning to make. So there's also talk about adding new tax brackets for the ultra wealthy. For instance, income over $400,000 may face higher marginal tax rate. That means that the personal taxes that you pay. This could affect not only high earners, but also small business owners who report their earnings as personal income. So while if you have a small business, you may or may not be drawing a salary, but if your business is what's considered an LLC or a limited liability corporation and you're declaring your business income as your personal income, if your business is wildly successful, and I know it is because you listen to this show, you could be impacted by any sort of capital gains changes in the tax code. Next, there's estate taxes. This is one of these. This is for those planning to pass down their wealth. The estate tax exemption, currently at around 12.9 million, might be reduced significantly. That means that more estates could be subject to hefty taxes upon transfer to their heirs. For families aiming to build generational wealth, this could be a serious hurdle of wanting to be conscientious about, am I leaving a big tax burden for the people that I'm leaving this real estate to? Then there is corporate tax rates. For small business owners, and let's qualify what a small business owner. If I'm not mistaken, the Small Business Administration identifies a small business as a business that's earning less than, I believe, $10 million. You might want to fact check that. But so when we think about a small business earning $10 million, that's a lot versus maybe your corner market that's not making anywhere close to that. All of those businesses are lumped into what's called a small business, right? So that's something important for you to know. So once again, for small business owners, the corporate tax rate might rise from 21% to 28%. While larger corporations often have the resources to navigate these tax increases, small businesses could feel the pinch, right? This makes optimizing deductions and structuring your business wisely even more critical than ever. So you see, these changes aren't just numbers. They are actually levers that can affect how much money stays into your pocket versus how much goes to the government. Whether you're an investor or a homeowner or a business owner, these proposals could impact your financial strategy. No matter what your strategy is, it could have some positive or negative impact. So you want to be aware. So now let's talk about how these changes might influence your day-to-day financial decisions. Whether you're saving for retirement, you're growing your investment portfolio, or you're running a small business, taxes play a huge role in shaping your financial outcomes. So first, let's talk about retirement accounts. And I know you've heard me talk about these. So if you're not really sure about what retirement accounts are, I have a whole episode that I've done on that. So you can go and take a listen to that show after you listen to this show. So for investors contributing to IRAs or 401ks, changes in the income tax brackets might influence how you allocate your contributions. Traditional accounts provide upfront tax breaks, while Roth accounts let you withdraw funds tax-free in retirement. If income tax rates rise, the Roth IRA route could be even more appealing to you than any other kind of IRA or savings plan. For example, let's say you're contributing $6,500 annually to an IRA. If your current tax bracket is 24%, but could rise to 32%, opting into a Roth IRA now might save you money down the line when your tax rates are higher. This is how you begin to strategically think about where and how you put your money away and whether you put it into a savings plan or a savings vehicle that positively impacts you today, or depending on what age you are, you might want to think about, I'm going to retire in 5 years. So I want to start thinking about, I'm going to have a different approach to this and thinking about how I'm going to be impacted when I take the money out, because I'm going to be planning on taking that money out sooner rather than later. Higher capital gains taxes could shift how you approach investing. Instead of frequently trading, maybe daily or weekly or monthly, you might lean towards a buy and hold strategy to defer and delay any tax obligations that you may have. Additionally, tax harvesting, which is selling underperforming investments to offset capital gains, could become even more valuable. And if you're not sure about what is tax loss harvesting, I also have a show about that as well. You can go listen to that episode. Now, let's talk about small business deductions. If corporate tax rates do increase, small business owners may need to double up on deductions like equipment purchases, employee benefits, and office expenses. This is where having a savvy accountant or tax professional pays off. Here's the big takeaway. Tax policy isn't just a background player in your wealth building journey. It's really a co-star. By understanding the changes on the horizon, you can begin to adapt a strategy to really stay ahead of the curve, right? So you really want to be thinking about, where am I in my age and where I'm looking to retire? And especially if you are in a situation where you have a life partner, and having these conversations with your partner to think about, where are you sitting and what might you need money to do for you at the time that you may either want to exit your corporate job, or if you're looking to be a digital nomad and live on the road, or maybe you want to be a tiny house owner and just crisscross the country. Whatever your goals are, start to think about what's the timeline for those goals? How much is it going to cost you on a regular basis, maybe an annual basis, to live based on that strategy? And then you can think about, okay, based on our current investing, whether it be a 401k or you're anticipating an inheritance, looking at the timeline of all those things can help you really start to think about and strategize about when do you want to pull what levers and when, and then looking at how might the tax policies of any administration, but particularly the current administration, how might it impact how the decisions that you need to make? And are you saving for the long term, meaning that you want to delay taxes, or are you saving for the short term, meaning you'd rather pay the taxes now so that when you take out the money later, you don't have any sort of taxes that you're paying. You get the money tax free. There's also things that you want to pay attention to. Age horizons. So there are different exemptions to some of the tax rules at certain age, at different age moments, right? So 65, 67. So you might be thinking about, if you are closer to retirement, the Social Security age, which I believe is 67 and a half. You might want to double check that. If you're close to that and you're going to have some relief, oh, well, then you definitely might want to take advantage of, hey, I want to pay more taxes up front so I can have less taxes that I pay, because I know that I'm also going to be drawing on Social Security, right? So, and you will have to pay taxes on that money. So this is the things that you want to have to think about. But once again, getting a professional, working with a professional, the goal is not for you to learn all 70,000 pages of the tax code. That is not the goal here. The goal here is that you're at least being aware, so that when you have a conversation with a professional, you have some understanding of like, where are you trying to get to? What are your goals? What's important to you now? What's going to be important to you in the future? What's your current financial situation? So that when you have that conversation with the financial professional, they can actually advise you with the best possible strategy, or at least give you options. And then you can make the best informed decision that you need to make for you and your life plans. So, but before we move on to strategies for navigating these challenges or these changes, I have a challenge for you. I really want you to take 15 minutes, just 15 minutes this week. You can take longer, but definitely a minimum of 15 minutes this week to review your current financial situation. Are you maximizing your retirement contributions through your workplace or some other mechanism? Have you reviewed your investment portfolio recently? A little time spent now could have you save big down the road. So I'm going to ask you to stay tuned for the next segment as we begin to explore actionable, do different, better strategies to keep your wealth building goals on track, no matter what your tax policies that come your way in this elected administration and future elected administrations. So I can't wait to see you back after the break. Welcome back, my tax savvy listeners. Let's talk a strategy. Taxes aren't just something you deal with in the last hours leading up to April, whatever. They're a year-round game plan. And if you want to play it smart, you can keep more of your hard-earned money working for you and not for someone else, like Uncle Sam. Here's how you can stay ahead of potential tax changes by tweaking your investment strategy. So first, let's talk about retirement accounts like 401ks, IRAs, and health saving plans accounts, or HSAs. Once again, I've done a whole show on all three of these. You can press pause, go listen to those so you can understand what they are, and then come back and pick up this show. But moving on, these three plans or financial instruments are valuable players in the tax game, right? Why? Because contributions to 401ks and traditional IRAs lower your taxable income now, while Roth IRAs allow for tax-free withdrawals in retirement. So here's a tip. If you're not maxing out your contributions, you're actually leaving money and tax savings on the table. In 2024, the contribution limit for 401ks is $22,500, with an additional $7,500 for those over the age of 50. For IRAs, the limit is $6,500, with a $1,000 catch-up for the 50 and over crowd. So don't let these limits go unused. Take advantage of them. But I want to take a step back and help you understand like what happens and why there's a tax savings. So when you get your paycheck and you are contributing to your company's 401k or an HSA, what those are called is those are taken out in pre-tax dollars, meaning that before the taxes are taken out of your paycheck, the HSA is your HSA and your 401k contributions are taken off the top. So once again, let's say you're making $2,000 a paycheck. The first thing that's taken out is your 401k or your HSA withdrawals, right? So those are called pre-tax, meaning the money is taken out before your payroll check is taxed. Then, so let's say once again, using our example, let's say your check is $2,000. Let's say your contributions are $500. What that means is your paycheck is now going to be taxed at $1,500 instead of being taxed at $2,000, right? That's what we mean when we say that these monies are taken out pre-tax, right? Before your federal taxes, before your state taxes, that your 401k distribution and your HSA distribution is taken out pre-tax, which is why when you go to withdraw it at the time of retirement, there's no taxes. I mean, you have to pay taxes on it, which is different than an IRA, right? An IRA, you're taking that money out after you've been taxed, right? So after you've been taxed by the government, you're going to take your contribution and you're going to put it into your IRA account. Because you've already paid taxes on that money, that's how you don't pay taxes when you go into retirement, because you've already paid the taxes already when you were paid out of your payroll for that money. So I know that might be a little bit confusing, but the key word here is pre-tax and post-tax. 401ks and HSAs are taken out pre-tax, meaning before your federal taxes and your state taxes are taken out of your payroll, and IRAs, the money comes out after you've paid taxes, which means you're not going to pay taxes again when you get ready to retire and withdraw money from that account. So I just wanted to give you that background. But once again, I have a whole episode on that you can go back and listen to where I go into a lot more detail. So next up, we're going to go into tax harvesting. If capital gain taxes increase, this strategy becomes even more critical. It's simple. It's sell underperforming investments to offset gains from winners in your portfolio. Now, you can use these losses to lower your taxable income even if you don't have significant gains. So here's an example. Let's say you sold stock A for a $5,000 gain, but you had a $3,000 loss on stock B. By harvesting that loss, your taxable gain drops to $2,000. It's like giving your portfolio a little spring cleaning and keeping Uncle Sam out of your wallet. Here's your action step. Review your investment accounts before the end of the year and see if there are any opportunities to harvest losses to maximize your contributions. It's a really simple but effective way to stay tax efficient. Once again, if this is something that you're not savvy enough to do on your own, there are professionals that can help you with this, right? And I have, once again, another show on tax advisors, but also portfolio advisors, wealth managers, and wealth advisors that can help you navigate some of these things and really set your portfolio up for success. But for now, let's pivot to talk to my entrepreneurs and small business owners. Potential corporate tax increases are looming. It's not a definite, but once again, this is something that you want to be paying attention to, okay? But with a little planning, you can weather the storms that may be coming. So, how do we want to optimize deductions? Small business owners have a gold mine of tax deductions at their disposal. Don't let them go unused. Think office expenses, employee benefits, equipment purchases, and even home office deductions if you work remotely or work in a hybrid work environment, whether it's for your business or even for your job. So here's a tip. Consider accelerating expenses into this year if you anticipate higher taxes next year. For example, purchasing equipment now instead of waiting could give you a bigger deduction when it matters the most by way of deducting the expense on your taxes because it is an expense for the company, but also, you get the advantage of depreciation as well, right? So depreciation is also a strategy that I love to use when trying to lower your tax liability or tax obligations, okay? So now let's talk about how to structure your business entity or maybe restructure your business entity. This one really is a game changer. If you're operating as a sole proprietor, it might be time to explore forming an LLC or an S Corp. Why? These structures can offer some tax advantages, such as reducing self-employment taxes or allowing you to pay yourself a salary and take dividends or not, which could lower your tax overall burden. This is definitely a tactic that I've used. So because my company actually, as a result of the company, has reasonable expenses that actually take care of a lot of my personal needs, I don't necessarily need to draw a salary or draw an exorbitant salary, because when you have an S Corp, you are what's called double taxed. And what that means is if I draw a salary from the company, I will be taxed, but also the company is taxed. But because some of my expenses that I need to live are actually taken care of by the company, I can actually go with a lower salary, which lowers my personal tax burden because of that. So I'll give you an example. So my car actually belongs to the company. It's a company car. So now what that means is my insurance is paid for by the company. The car expenses are paid for by the company. But as an executive, I use that car to get to all of my meetings. But I use that car only for company business. But all of my business is company business for the most part. So the gas that's for the car is paid for by the company. The insurance for the car is paid for by the company. And any repairs for the car are paid for by the company because the car is a company car. Right? So all those expenses by which I would need my salary to pay for, I can lower my salary because I don't have any of those expenses, which, by the way, is a good chunk of my expense, right? I know some people they might have a home that also serves as their business. So if you have a business that is maybe a sober house and you live on the property, well, you're getting your living expenses taken care of by the nature of you living in the property that is the business. Now, once again, there is IRS code that goes along with this around what are reasonable expenses for the type of company you have. So not every expense can be deducted for every kind of company. A certain kind of a company that's a sober living company has certain expenses that are reasonable for that company versus my company as a consulting firm or an investment fund. They have different kinds of expenses that are reasonable, which are also different than a cookie company. So really you have to understand what is called reasonable expenses, meaning that is it reasonable that a business of this type would have that type of expense? That is what the IRS would be looking at if for any reason you were to get audited for any of these expenses, right? So, but Changing your structure can offer you some really great tax advantages, right? So here's an example. An S Corp owner can split income into between salary and dividends, potentially reducing the payroll tax obligations. It's a really smart way to keep more money in the business and less in your personal taxes. So here's an action step for you. Schedule a meeting with your accountant or tax advisor to explore the best entity structure for your business and life plans, right? I think that sometimes that gets missed. Thinking about, because there is a human behind the business, so making sure that the tax structure of the business not only works for the business, but also works for you personally. But really at the end, small changes now can save you big bucks later. Now, finally, let's tackle a topic that doesn't get enough attention, but is absolutely critical, and that is estate planning. Changes to estate taxes could have a major impact on how you transfer wealth to your heirs, whomever they be. It could be a sibling, it could be children, it could be a friend, and it could be a charity. So you want to be mindful of what the implications might be. So, with potential reductions in the estate tax exemption, more families might find themselves subject to these estate taxes. Currently, the exemption is around $12.9 million, but proposals could bring that down significantly. This means that more of your estate could be taxed if you don't plan ahead, right? So let's say maybe you have a property that could be possibly inherited that has $1 million value. Well, you want to pay attention to what's going on with the estate tax code and inheritance codes, because that could be a great big implication for your heirs and your family. So here's a tip. Consider setting up a trust, and that helps shield the assets from estate taxes. Trusts aren't just for the ultra wealthy. They're for anyone who wants to ensure that their assets are transferred efficiently, effectively, and with the most tax advantages as possible. So there's another strategy that you can take advantage of. Taking advantage of an annual gift tax exclusion allows you to gift up to $17,000 per recipient tax-free. Over time, this is a really great strategy that can significantly reduce the size of your taxable estate. Then, if there's charitable giving, if you're charitably inclined, donating to nonprofits through a donor-advised fund can reduce your taxable estate while supporting causes that you care about. It's a win-win. So here's an example. Imagine gifting $50,000 to a donor-advised fund, and these are generally run by community foundations, but also financial institutions. Again, I have a whole episode on donor-advised funds. That reduces your taxable income now and sets you to make an impactable charitable contributions over time. So here's my action step, or my call to action to you. Review your estate plan, or start one if you haven't already. Meet with an estate planning attorney to explore trusts, gifting strategies, and other tools to minimize your taxes and maximize your legacy. This is not something I recommend you do on your own. There are some platforms out there. I think Will and Trust. There's some other platforms that are out there that will say, hey, we can set up your trust for you state by state, and you don't need an attorney. And now, obviously, if an attorney is not in your wheelhouse, it's not in your budget, what I would recommend is saving for one. Going through the estate planning process, depending on where you live, it's going to be about $2,000. And now that is going to depend on the size of your portfolio. But if you have a modest portfolio, and when I say modest portfolio, let's say under a couple of $1 million, meaning that the size of your home or all your total assets is less than $2 million, then likely it's going to be around $2,000. Once again, this could be swayed where you live, but I would definitely go and ask around, get some quotes from some attorneys of what it might cost, but have an idea of what your estate value is. How much do you have? What's the value of all of your assets that you plan to pass down or put in the trust? And they can give you a ballpark figure. But $2,000 is what I've heard. My son was looking into a trust in Nevada, and he was looking at $1,800 to $5,000. But once again, this is all reliant on the size of the trust and how many properties there are, how many people are going to be heirs, or how many executors you're going to have. But the more simpler portfolio, you're probably looking at about $1,500 to $2,000. I would definitely save for this, because what you don't want to do is have your properties go into probate, especially if you have a small business, right? But moving on. Definitely work with a professional to help you set up the trust in a way and your gifting strategies in a way that are going to be beneficial to you, not only today, but to your heirs in the long run. So before we wrap up this segment, I want you to remember this. Tax planning isn't just about saving money. It's really about aligning your financial strategy with your goals and ensuring your hard-earned wealth is working for you. And now, I want you to stick around, because in the next segment, we're really going to be diving into practical tips to stay proactive and adapt to the ever-changing tax landscape. Let's do different better. See you after the break. Welcome back, my finance trailblazers in training. Let's dive into the final leg of today's episode, long-term strategies to keep your wealth building goals aligned with all of these ever-changing tax laws. Okay, tax laws are like seasons. They change and we need to adapt. Start by building flexibility into your financial plans. Diversify your income sources so that you're not overly reliant on any single income stream that could be hit hard by any one tax change. So, for example, if you're pulling income from a high tax bracket salary, consider supplementing this with tax-advantaged accounts like IRAs, HSAs, and also charitable contributions, which offer tax-free withdrawals under certain conditions. Once again, that's for the IRAs and the HSAs, not obviously for your charitable contributions. So, but think of this as your financial plan as a table. The more legs that it has, the more stable it's going to be. Diversifying your income sources gives you stability and flexibility, no matter how the tax laws evolve. So, let's talk about being proactive and around tax increases. So one thing is to shift to tax efficient investments like municipal bonds, which offer, they give you tax-free income, right? Also evaluate converting your traditional IRA to Roth IRAs during lower tax years. Yes, you'll pay some taxes now, but you'll enjoy tax-free withdrawals later when the rates may be higher. So we talked a little bit about that in the previous segment. But your future self will thank you when tax-free income is rolling in during your retirement. And trust me on this one. So really, once again, you want to look at your time horizon. What does retirement look like for you? Not only in your chronological age. So you might have a goal of retiring at 55 and you're 40, but the actual federal government retirement age is 67 and a half. So what needs to happen between 55 and 67 and a half? That is a different thing than whatever your plan is, because you're still going to be taxed at a certain rate. So these are all the things you need to kind of triangulate, and why it's helpful to have a professional support you on this journey. But for right now, let's talk about making this whole tax planning process easier. Because who has time to wade through IRS jargon? I certainly do not. And thankfully, we have some technology on our side to help us. So there's some great tax planning tools and platforms. These are not sponsored, but for individuals using platforms like TurboTax and H&R Block and some others that are out there, these can help you handle your personal tax returns. And what's great about them is they guide you step by step by step. They flag deductions or credits that you might miss. They've got a whole machine that's paying attention and on top of all these tax code changes. but also they offer some protection if you get audited. For years in the past, I've used TurboTax, and what I love is their audit protection, right? So if for any reason you do get audited, there's going to be a professional that can walk side by side with you. And once again, an audit may not happen right away. An audit typically will happen sometime in the future. It could be 3, 4, 5 years in the future. So to know that you've got that resource that's available to you is the peace of mind to sleep. It's usually what, $80 to know that somebody could walk with you 5 years from now through that whole auditing process. There's just no price for that. Like, right? Chef's kiss. Mwah. Okay. Now, for small businesses, you might want to use a tool like QuickBooks or Xero or Bench. Once again, no sponsorship here, but these could simplify your expense tracking, your payroll, and help you prepare for tax time by organizing your finances throughout the year. I was just talking with an entrepreneur literally yesterday about why I love some of these platforms, especially if you have employees. It makes it super, super easy to make sure that all of your employment tax filings are done. You can set it up so they get automatically sent. You don't have to think about it. And as a small business owner, you have enough to think about already without all the forms that need to be sent to all the agencies, whether it's state agencies or federal agencies. But to know that your platform that you are subscribed to is going to do all of that all on its own, incredible time savings, right? The less you leave to memory, the more money you save, I promise you. Trust me, automation is your friend. However, you do want your automation to be checked, once again, either by yourself or a professional. But for the most part, a lot of these platforms are significantly save you time, and by making sure that you're not having to print out things, put in it, fold it, put it in an envelope and mail it to the appropriate agencies. They are digitally sending it to you and then sending you a confirmation that it has been received by that particular agency. So now let's talk about when to bring in a professional. While tech tools are great, these platforms are amazing, nothing beats personalized advice from a pro, and particularly a certified public accountant or CPA. Or a tax advisor. They can help you craft customized strategies that are for your business and for you, especially if your finances are complex. If you own multiple companies, you have some assets before you got married and assets you built up with your partner in addition to a small business. You know, the more layers, my invitation to you is the more you need a professional in addition to any platform that you might be using. Let's be real. There is no shame in calling in an expert. A good CPA can actually uncover savings that you didn't even know existed. Remember when I told you that the tax code was over 70,000 pages long? Well, it's their job to know all the 70,000 pages. Think of them as your financial fairy godparent. Now, a financial advisor can also help you align your investment strategy with tax efficiency. For example, they can recommend when to sell investments or shift money into tax-advantaged accounts. Here's a tip. Look for advisors who specialize in tax efficiency. It's like hiring a personal trainer with your wealth building goals in mind, right? So I really want you to really start to think about how and where and when and why, how all these pieces start to come together. And I understand it can be completely overwhelming, and that's reasonable. And so once again, I've said this in previous shows, this is a journey, not a destination. I really want you to start thinking about building a practice, building a muscle around all of these financial strategies, particularly tax strategies, of like putting it on the calendar and making it fun. I know this isn't necessarily the most exciting topic. Taxes is not on the top of everybody's playlist. But once again, if you are really building a practice around your personal financial management, your small business financial management, your big business financial management, one, it's probably going to really reduce some of your anxiety and reduce some of your fear around what's happening in your financial life. And so really thinking about, and particularly if you have a significant partner in your life, or even if you have kids, bringing them into this conversation, make it a date, make it a day of it. Hey, we're going to go and have a spa day while we talk about financials, right? Our financial future. Match something. Maybe this topic has a lot of weight for you because of your family history or cultural history. So match something that you don't like, which might be talking about finances and financial management, particularly taxes, with something you do like. Talk about this over a beautiful meal. Maybe, I know for us, when I love going to the cabin. So in one of the days that I go to the cabin, I love to like splurge one night of the week when we go to the cabin. So maybe that's the night we're like, hey, let's talk about what's going on in our financial future. What's going on? What have you heard on the news that might impact us financially? And you can make this a regular conversation. And I promise you, if you make it a regular thing, you're going to start to see and feel less anxiety. You're going to start to feel more engaged, and you're going to start to feel more comfortable about talking about it. It's going to begin to feel less taboo because you're exposing yourself and you're exposing your partner, and whether it's a business partner, a life partner, having these conversations more openly, more transparently. It's just really going to build that muscle, but also make it empower you. You're going to start to feel stronger because you're going to start to feel like, hey, we're going to have this conversation and we're going to have some action steps. And then we're going to come back and have this conversation again. And we're going to have some action steps. And then you're getting smarter every single time you do it. Right. So once again, I love Tony Robbins talks about, if you put 1% effort every day, at the end of the year, you're not 365% better. You're actually exponentially maybe 36,000% better, but because of that incremental 1% effort every day. So I just really want you to start to build a muscle around this and start small. You might have a lot of trepidations, you might have a lot of fear, but just start. That is my wish for you. My goal for you is just start. Start by making a date with a friend, with a colleague, with a partner to say, hey, let's just have a conversation about what have you heard in the news that you are concerned might impact you financially? Just start there. And that will open up the door for more conversation and hopefully more curiosity. But once again, once you get to a certain point, I definitely encourage you to bring on some professionals like a wealth advisor. And I have a whole episode where I talk about how wealth advisors are paid. You don't necessarily have to pay them upfront. Some of them will actually give you some time pro bono before you actually begin to engage them formally. But don't let the fear of what it might cost you deter you from exploring what your options might be. But really, a financial advisor is really going to help you align your investment strategy, some tax efficiency, but also your personal goals. Remember when I talked about what life stage are you at, what life stage is your business at, and what life stage is your partner at or your family at? These are all things that need to be taken in consideration of when and how and what levers you might want to pull, because you don't want to do something that's going to be disadvantaged for you. But these financial advisors will be able to help you make decisions about when to sell investments or shift your money into different tax advantaged accounts. So now what I want to do is I want to bring it all together. Taxes don't have to feel like an unavoidable drain on your wealth, right? With the right strategies and tools, you can really stay ahead of the curve and keep your financial goals on track. All right. So here's some action steps. Review your current financial plan. Are there areas where you can improve your tax efficiency? Action step number 2, schedule a meeting with the tax professional or CPA before the end of this year. This is the perfect time because come January, they're all going to be too busy. All right, so do it now. Action step number 3, explore one new tool or platform to simplify your tax planning, whether it's QuickBooks or tracking expenses like TurboTax for your tax filings. Remember, staying proactive is key. Don't wait for tax season to start thinking about taxes, but build it into your strategy all year round. Here's my final thought. The tax laws may change, but your commitment to your financial goals shouldn't. By adapting your strategy and leveraging technology and seeking expert advice, you not only save money, but also grow your wealth in a sustainable way. Well, After all that, that's a wrap for today's episode of Do Different Better. Today, I talked about a few of the new administration's proposed tax changes and how they might impact your financial future. Whether you're an everyday investor or a small business owner, or you're planning your estate, these policies could shift how you save, spend, and invest. I hope you're feeling more empowered to tackle taxes head on and maximize your wealth building potential. If you enjoyed today's episode, don't forget to subscribe and leave a review and share this episode with somebody who's ready to make a difference with their money. Let me know what you think of the show. We love comments, so tell us how this show helped you. If there's a money or finance question you have, or if there's somebody you want me to interview, hit me up on LinkedIn or Instagram at Do Better with Elaine. I will see you next week, and I'll show you how to do different better.